There's an infinite array of investment possibilities to suit every type of investor and risk appetite. You could take a long-term approach, in which case you may buy and hold shares in mature, blue-chip companies. But what if you have a more aggressive approach? What if you want to maximize the impact of the cash you have available? What if you want the flexibility to take and liquidate a position at short notice, to take advantage of alternative opportunities and transfer your resources elsewhere? What if you are indifferent to actually owning the investment asset itself, but simply want to profit from its performance? If these are your trading priorities, then you might consider contracts for difference, better known as CFDs. Contracts for difference allow you to invest in the performance of a vaster range of securities and asset classes, such as shares, equity indices like the S&P 500, and commodities such as gold, but without having to actually purchase or own the underlying asset. Instead, you enter into an arrangement with your broker to put up a relatively small sum, often around 10%. This is known as margin. It's designed to cover any day-to-day losses that arise, while your broker effectively funds the remainder of your investment. We'll look at margin and leverage through a few examples, but let's take a moment to look at the differences between CFDs and stocks. A stock is a share of ownership in a company. By purchasing a stock, you become a shareholder in that company. You may benefit from dividends, can vote on key corporate decisions, and possess certain rights. To buy 100 stocks in company ABC at $10, you need $1,000. Purchase equals ownership. The price of a stock goes up and down depending on many factors. You purchase the stock at a quoted price, and the rise or decline in the stock's value results in either a profit or a loss. It's considered a traditional way to trade financial markets. And trading stocks means you have to purchase them before you can sell, meaning that you can profit from a rising price only after you've bought the stock. If the stock drops below your purchase price, you lose out. If you believe that the general market trend is downwards, CFDs are going to be beneficial to your strategy. So what about a CFD? A CFD, or contract for difference, is a contract between you, the investor, and a CFD provider. It's an agreement to settle in cash the difference between an opening price and a closing price of a particular asset that you have taken a position on. The CFD then tracks that asset price. That's the direct relationship between them. You take the position based on whether you think the asset will go up or down in value. So, for example, you can place a CFD trade on a stock, and the value of the CFD position will rise or fall with that stock price. The stock is therefore known as the underlying asset. And as you are purchasing a CFD from a provider, then you don't own that underlying stock. Not owning the stock leads to some key differences. For example, CFDs are traded on margin. You only have to put up collateral. This means you can leverage your capital. The amount of margin required varies and is defined by your provider. But if it's 10% typical for large companies like Apple, then that is the equivalent to 10 times leverage. Buying the ABC stocks in the example at the start of this CFD explainer was $1,000. If you bought them with a CFD at 5% margin, you would require $50 in your account. Your profit or loss would move with the ABC stock price in the same way as if you owned it. Therefore, the low CFD margin requirement means any profit percentage is higher, but any downward movement is also magnified. But CFD trading means that you can sell stocks that you don't own. Remember, it's still a contract between you and the CFD provider, not ownership. Therefore, CFDs allow you to benefit from a falling market. You can sell a CFD on a stock that you believe will fall in price and then aim to buy it back later for less money and make a profit. But remember, if it rises in value, you'll potentially lose money. And stock trading is one asset type or class. A CFD, on the other hand, is an instrument, a derivative. Therefore, CFDs can be used to deal on stocks, foreign exchange, commodities, and so on. And therefore, more international markets open up to you as an investor, allowing for portfolio diversification, all from one CFD account. You want to invest in company ABC. It's trading at $10 per share. You believe that the stock is going to rise, and therefore you want to invest. You want to purchase 1,000 shares. With a traditional stock purchase, this would cost you $10,000, 10 times 1,000, plus any associated costs. So you buy the stock and it goes up to $11 per share. You decide to sell the stock and therefore get $11,000 back. This would net you a $1,000 profit, ignoring trading costs for the sake of this illustration. Your $1,000 profit on an initial outlay of $10,000 means a 10% profit. If you'd done the same trade via a CFD, it would have had different consequences. Let's say that your CFD provider quotes a margin of 10% on the ABC stock. Therefore, to buy $10,000 of shares, you'd need $1,000 in your margin account. As the shares went up to $11, you closed the CFD position and, just like the stock trade, you make a $1,000 profit. But there's a key difference. You invested $1,000 and made $1,000. Therefore, instead of a 10% return on investment, the CFD would give you a 100% profit. Clearly, trading on CFDs has advantages, but beware. Margin trading has two sides to it. Whilst your potential profits can be magnified due to the fact that you haven't paid the full stock price for your CFD position, conversely, losses are also potentially higher. Margin also subjects the investor to a number of unique risks, such as interest payments for use of the borrowed money. It's essential that, as an investor, you understand the advantages and the disadvantages of any financial instrument before you start trading. Apple shares are trading at $99 to $100. You buy 500 Apple CFDs at $100 each. That's $50,000 of notional investment. Putting in cash of 10% of $50,000 into your margin account, your equity is $5,000. That's 10% times $50,000. Your broker then finances the other 90% for you in the market. Later in the day, Apple has risen to $103. So you sell your 500 Apple CFDs for $103 each. If the trade was left open beyond the first day, you'd have to consider an interest payment too. But for now, let's keep this example simple by ignoring the impact of interest and commissions. So have you made a profit or loss? In this case, it's a profit of $1,500. Apple shares have risen from $100 to $103. That's a 3% rise. But your actual return is 30% because you only put up 10% of the purchase price in cash. So your profits are 10 times the rise in the share price. In summary, you could have bought Apple shares and made some money if they rose. Instead, you bought a CFD on Apple shares and the profits were 10 times leveraged. As we demonstrated, one key feature of CFDs is this leverage or gearing. Another is that a trader can enter the market by selling an asset or going short. In this example, you believe that the gold price is about to fall, so you sell gold CFDs in the hope of being able to buy back the asset at a lower price and therefore make a profit. Closing your open trade is also known as squaring your position. Warning: leverage increases risk. You need to realise from our previous example that if Apple fell by 3%, you'd be down to $3,500 cash in your margin account. That's the original $5,000 less your losses of $1,500. That's a loss of 30%. Indeed, your losses could exceed $5,000 if Apple's shares fell rapidly. Back to gold, which is trading at $1,000 to $1,006 an ounce. You sell a CFD on 50 ounces at $1,000. That's $50,000 of notional investment. In this case, you might put in 4% cash margin of $2,000. Your broker finances the other 96% of the sale. Now this trade then is 25 times leveraged. Later in the day, gold has risen to $1,008 to $1,024. So you buy 50 ounces of gold as CFDs for $1,024 each. Your gold book is now square. So have you made a profit or a loss? In this instance, it's a loss of $1,200. The loss is because you sold and the market rose. Gold has risen from $1,000 to $1,024, which is a 2.4% gain, but you are 25 times leveraged. Your losses are 60% of your cash margin. So you need to understand that as your initial cash margin is spent, your broker will require extra cash to keep the position open, as they would had Apple shares fallen. Again, if the trade was left open beyond the first day, we would have to consider financing costs too. But once more, let's keep the example simple by ignoring interest. CFDs are traded on margin. You only put up a percentage of the trade as collateral based on requirements set by your CFD provider. Therefore, you can trade a position on a stock, other asset classes can be traded via CFDs too, without actually owning it as an asset. Trading on margin means that as an investor, you rarely have to put up the entire cost of a trade, as you would with a stocks investment. You're required to maintain a certain amount of margin in your account, as defined by your CFD provider, but it's a fraction of the cost of buying stocks outright. CFDs can be traded on a variety of assets and instruments from one account. This means that you can set up a diversified portfolio covering many different markets and have access to much wider trading options. Stocks, indices, commodities, the list goes on. A CFD is an attractive alternative to other financial vehicles. CFDs therefore allow you to explore many alternative options. You can trade a CFD to benefit from a falling price or market. For example, you might have concerns about buying individual stocks. Therefore, instead of buying stocks, you could use CFDs to short a particular stock or even the index, and therefore gain potential profits from a falling market. CFDs are a mechanism that allow you to be an active, engaged trader, whatever the market conditions or your strategies. CFDs can also have regional benefits, or in some cases, be banned. For example, in the UK, as you never own the asset, your CFD is not liable to stamp duty. Conversely, if you're an investor in certain parts of the world, CFDs are not a product you can purchase. Many CFD guides present the concept as an extremely cost-effective method of trading, and they can be, but it's essential that you're aware of the entire process. In other words, all the costs associated with CFDs. For example, the cost of paying the spread on the entry purchase and exit sale can rule out any profits that have been made if there had only been small movements in the price of the underlying asset. So look carefully into which brokers suit your needs. CFDs also have the benefit of being able to add a stop loss. This is an automatic mechanism whereby you can exit the CFD at a chosen point before your losses pass a certain level. CFDs are also a transparent mechanism. They are closely related to the buying and selling of stocks, and one stock usually equals one CFD. Whilst the process isn't complicated, like any financial product, it is still worth researching CFDs before you trade. Leverage is a fantastic way of making your money work harder, but there are two sides to leverage trading. Whilst profits can be amplified due to a potentially small minimum outlay, remember that the smaller the initial margin, the higher the leverage. Therefore, losses are magnified in the same way. Be aware that you are liable to pay losses incurred based on that leverage, something that is never encountered with stock trading. The margin level can also be open to change by the CFD provider, and therefore the investor may need to add additional funds. So let's summarise what you've learned. CFDs can be a cost-effective way of expressing your views on the markets. By leveraging your account by using margin, you can buy and sell CFDs without committing all of your collateral. Because CFDs are a leveraged product, the potential profits are magnified. But on the other hand, so are potential losses. Your losses can exceed your initial outlay. Be wary of the amount of leverage you're employing and make sure you understand the mechanism before entering into a trade. CFDs are flexible. You can trade a range of assets around the world, all from one CFD account. Again, make sure you're only trading on products that you understand. You can make trades to benefit from a falling market. By selling a CFD, you can make a profit if and when the underlying asset falls in price.